I'm Philip Clark, Farmers Weekly's Economics and World Editor, and I'm here to talk about exchange rates. As most farmers will already realise, sterling has been going through a period of unprecedented weakness. 12 months ago, £1 would have bought you €1.40. This week, £1 would get you just €1.15, a drop of 20%. And the signs are that the slide is not over yet. Further cuts in Bank of England interest rates in the new year could trigger further currency falls, and some city traders believe parity between the pound and the euro is not that far off. But what does it all mean for farmers? Well, to a great extent, the weakness of sterling is very good news indeed. Historically, there is a direct link between total income from farming and the prevailing exchange rate. As the graph shows, when sterling was last at these levels, in the mid-1990s, farm incomes were at a record high. As the pound then strengthened, so farm incomes slumped, bottoming out in 2001. Since then, there has been a gradual recovery, and the expectation is that with sterling now back to 1990s levels, farm incomes should rise too. That's the theory. But what about in practice? Well, there is no doubt that a weaker currency is good for the balance of trade. It has the effect of making exports more competitive, in effect delivering more pounds sterling for each tonne of product sold in euros on the continent. At the same time, imports become less competitive, as overseas suppliers find it harder to undercut our domestic market. And that seems to be exactly what is happening. Take the meat trade, for example. Latest figures from AHDB Meat Services show beef export earnings have almost doubled to £150 million so far this year, most of it coming from sales of cow beef. Pig meat and lamb exports are also significantly higher. But it's the effect of the currency crash on imports that is proving the real benefit. Irish exports in particular are squealing as they get fewer euros for each tonne of meat they ship to the UK each week. In the dairy sector too, farmers are reaping the rewards. While French, German and Irish milk producers have all suffered price cuts in recent weeks, British dairy farmers have seen their milk cheques hold steady. To some extent, this is down to the fact that the UK is suffering an acute shortage of milk. But currency is also helping hugely. In the last few weeks alone, the intervention price of butter and skim milk powder have climbed almost 10%. Manufacturers are also getting more for their butter and cream sold on the continent, and cheddar cheese is holding steady in the UK, where elsewhere it is falling. It's a slightly different story in the grain trade. Wheat and barley prices, for example, are still bumbling along in the low to mid £80 a tonne range, almost half of what they were a year ago. This reflects the current surplus weighing down on the global grain market following this year's record crop. But the reality is that, were it not for the 20% drop in currency, cereal growers would be getting just £60 to £65 a tonne for their grain just now. Overall then, the weakness of sterling is benefiting British farmers significantly. It's also given a big lift to subsidy receipts, with single farm payments worth more when converted from euros to pounds. Going back to the graph, it seems fairly likely that farm incomes will show an upturn in 2008. Recent estimates by consultants Andersons suggest total income from farming will hit £3.5 billion this year, the highest level since 1997. But prospects for 2009 are more questionable. Currency weakness is likely to prevail, but quite what will happen in global commodity markets as the economic recession bites deeper is anyone's guess.